2023, that is a wrap. It's time to look back on the predictions that I made on what was going to happen in 2023 to see if I nailed it or flubbed it. I think I nailed some of them, but I definitely flubbed some of them. Let's dive in. But before we do, my name is Mike Pern. I'm a local real estate agent here in Metro Detroit. If you're looking for a new home, I've got your back. So prediction number one, home values falling 8 to 10%. And here's what I said. Let's take a look. My prediction is home values are going to fall 10 to 15% here locally in Metro Detroit in 2023. Some areas that like luxury are going to be hit a bit harder. Cities with homes at or below the Metro Detroit average sales price at $306,000, we're going to see a more temperate fall of maybe 8 or 10%. Nationally, there's going to be areas that fall 20%. It's just going to happen. Well, I sure got that one wrong. Not only did home values here in Metro Detroit not fall, they actually rose over 6%, even with the extreme downward pressure of interest rates, eventually hitting 8% late in the year. Thankfully, they've come down a little bit, but what the economist and myself frankly missed were two things. The very few people selling their homes and trying desperately to hold on to their low rates that they have. Over 80% of homeowners in America are still at or below 4%, and that's a huge difference in payment from that to a 7% interest rate of the day today. Not to mention, if you're in the majority of sellers and buyers that would have been move up sellers, then you're moving up to both a higher priced home and a higher rate mortgage, which really compounds itself. We're seeing a lot of our buyers and sellers right now, payments actually almost triple as they're moving from their smaller home to a bigger home. So this caused a lot of sellers to pass completely on selling, keeping inventory really low, keeping the upward pressure on prices high. On the flip side, most economists also underestimated the rents pressing hard on first-time home buyers to actually get them into homes, namely the younger millennials, to swallow the interest rate hikes and still buy. So the average sales prices did fall about 5% because the number of first-time home buyers increased dramatically, but overall, the values of those homes went up 6%. Prediction number two, interest rates, and that's on everybody's mind, right? When is Powell going to stop the madness of raising the rates rapidly? Towards the end of 2023, and that's definitely 2024, we're gonna see rates start to come back down to reality into the 5 range, 6 by the end of 2023, 5 by the end of 24, and probably settle in for about 4.5-ish for the foreseeable future after that. Nailed it. Nailed it. We did hit interest rates that started with an 8 for about a month, 45 days depending on the bank, and now we're back into the very high 6s, touching 7 depending on the day. The Fed already has committed to upwards of 4 interest rate cuts next year to try to steer the economy properly now that we've got inflation under control. But I wouldn't expect that until closer to the end of 2024, definitely not the start. I'm not looking at rates to come down in January. Prediction number 3, this was about HELOCs. What did I say? I predict 4 times the number of home equity lines of credit are gonna be issued in 2023 than were issued in 2022, in the average amount of 40 to 50,000. It's gonna hover right in there on average. And honestly, guys, this is not good. This is not good at all. So HELOCs did go up 40%, but only 40%, not the 100 or 150% I expected, because a lot of banks frankly just stopped giving them mid-year, forcing people to do cash out refis instead. And frankly, that's a shame because that meant people had to give up their rates in the 3s for ones in the 6s or 7s. And why did so many people do it? Consumer debt, aka credit card debt, exploded over the last 2 years. And with credit card rates in the 15 to 30% range, I'm not kidding, that's the interest rate on credit cards. Go look at your credit card statement. A lot of people are paying a blended interest rate, which is your mortgage rate, your credit card rate, your car loan rate, all of it, in the 11 to 13% range. And consolidating that into one payment at 7% made a lot of sense for a lot of people. Here's my fear on this, and the one thing that I'm monitoring each and every month is that people are using their homes like an ATM like they did in 02 to 07, reducing their equity position versus just adjusting their lifestyle and spending. Time will tell, but early indicators, namely this past holiday shopping season, is showing consumers spending 8% more year over year, the highest level ever spent on Christmas, and it's telling me people are not changing their lifestyle. This again is something I want to monitor because while Americans have the most equity on average ever, if they pull out that equity, then we're going to see this swing back happen. So right now, the average American has 56% equity in their home, which is a lot different than it was in 2007 and 8 when they had less than 10% equity on average. Now, 56% equity means people are not going to walk away from their home and foreclosures are not going to happen. And we've seen that hold true so far. The number of defaults are almost at their lowest time ever. But if we start to see that creep back up closer to 80%, well, we all remember what happened in 08. And that sucked. New construction, let's take a look. Prediction number 4, home builders are going to cut building by 50% in 2023 versus 2022, and the builders are going to offer incentives, one of a combination of the following: interest rate buy-down incentives with either 3-2-1 loans or 2-1 loans, price reductions for the homes that are sitting on the market or are 80% or more completed. Now, typically, the better lots in a neighborhood sell at base plus premium. Yep, that happened. Builders cut new starts almost 50% and started in on incentives. There are builders that also cut out realtor commissions in the run-up years like Lennar, but these guys are back paying agents again for their buyers. One twist we'll see, builders are starting to build smaller, more affordable homes again because frankly, that's what the market dictates and that's what's selling. Number 5, the stock market. What'd I say? My prediction is the market's going to recover about half of its losses, let's call it 8% in 2023, and will be poised for actual positive growth in 2024. The inflation, rapid decline in tech stock value, and interest rates, of course, skyrocketing has caused the market to crash, but it's going to get better as inflation comes down and those interest rates start coming down by the end of the year. Nailed it. We ended 22 and started 23 pretty rocky, or to put a fine point on it, it sucked. Like frankly, the market just sucked. Sure enough, both the Dow and the NASDAQ recovered quickly through the year, proving out Morgan Housel's point from the book, The Psychology of Money. It's better just to hold through the ups and downs than try to predict what the best, absolute best day to sell a stock is and the absolute best day to buy a stock. In fact, that's damn near impossible. All right, guys, giveaway time. On a total whim, I'm gonna give out 10 books to the first 10 people that like and comment on this video and also subscribe to the channel. Email me when you've done that, and you're gonna get a copy of The Psychology of Money, either hard copy or Audible, your choice. Again, email me at the email on the screen when you've done it. We'll verify it and get that shipped out to you ASAP. Number 6, inflation. In 2023 is still gonna be high, but not as high. I think we're gonna end the year somewhere between 4.5% and 5% for inflation as an average, which is still way above what's considered a healthy inflation rate of 1.8 to 2.2, which is of course the target. Nailed this one too. Inflation has finally come under control. Finally. Now, prices haven't really come down, so every week going to the grocery store, holiday shopping, filling up the gas tank, we all know prices are still super high, but at least they've stopped rising at the crazy rates of 7, 8, 9% year over year, which is amazing. We're down in the 3% range, which is probably where we're gonna sit for the next couple of months. Number 7, contractors. Prediction number 7, we're gonna talk about contractors. Finally, in the second half of the year, we're gonna see the demand for great contractors start moving down, but not till the second half of the year. So if you've got a project like a kitchen or a bathroom remodel coming up, I'm advising wait until August or after. You're gonna see quotes coming down 5, 10, 15%, and some of the best contractors that are really hard to get a hold of because their calendars are just booked are gonna start opening up a bit. Now, I'm still waiting for the data from the Department of Labor and Economic Growth, but I think in the second half of the year, contractor demand did in fact come down. Now I'm looking at indicators of new construction showing people spending less on remodels than they did during the pandemic. And frankly, a lot of this is anecdotal, but I'm gonna use my parents as the example. So they're redoing their kitchen. In 2022, it was almost impossible to get someone out just to give them a quote. Just to give them a quote, like literally people were just standing them up for appointments. They did get their bathroom redone and the work was frankly expensive and shoddy. Now, however, the kitchen remodeling companies are proactively calling them and trying to move up their timetable to keep their good people employed. When the data comes out, I think we're gonna see that prediction extremely accurate. I'll let you know in a month. Number 8, by the end of the year, I think some of the Bitcoin and Ethereum are gonna recover 15 to 25%, but only that. We're not gonna see Bitcoin go up to 60,000 here. It's just not gonna happen. Yep, that crypto winter continued with even more crypto collapse. Only now in the last months of 2023, Bitcoin is reaching 40K again. And so I said it would recover and it wouldn't recover to the 60K. So I'll take that as pretty accurate. Personally, I'm still not a fan of crypto and found picking up a few more Airbnbs much more stable and lucrative because of the tax incentives involved. Give me a call if you want to talk about tax incentives and how rental properties can offset your income. Doesn't matter if you're W-2 or 1099, you can definitely get some massive, massive tax write-downs by picking up a good Airbnb. Number 9. The luxury real estate market. But I'm predicting a 30% decline in the number of homes sold in the plus million sector. And this sector is gonna hit the hardest as well with price decreases in 2023. So this one's a push. Time on market for homes above $1 million here in Metro Detroit did almost triple. The number of unsold homes going off the market also doubled. Prices didn't come down, but there was a significant 15% decline in the number of homes sold in the luxury market. So it's a push. Not right, not wrong, in the middle. Next up, rents. Now let's see what I said. So we're gonna see rents probably overall increase, not necessarily the prices from today, but we're gonna see rents increase from the people who had signed a lease a year ago that now have to release the same property and will be paying 10% more. Okay, pretty accurate. So rents came down 10 to 15%, which is great because they spiked to an all-time high in the United States. Actually, the average rent in the United States hit $2,000 per month on average, $24,000 per year. That's craziness. But they did come down 10 to 15% depending on the city, depending on the metro, right here in Metro Detroit, which is great. However, people were still releasing their apartments, and even though rents came down, they're still up 10 to 30% over the previous payment. Again, pushing people into not leasing and finally buying a home. Last but not least, FHA and VA. Prediction number 11, and this is the last one for 2023. FHA and VA buyers are going to be the ones in the market in 2023. So those loans did tick up 22% in 2023, mainly the second half. Not as far as I thought, but also that tells me the market's slowing. From a seller's perspective, loans and buyers are kind of like a deck of cards. Cash is the ace, 20% down without an appraisal is king, 20% down with an appraisal is a queen, conventional at any amount down is a jack, FHA a 10, and VA a 9. In euchre, we'd rather have aces and kings than 9s and 10s. Sellers view the financing type the same way, and yes, I realize that there are bowers out there, but this isn't that technical of an example. Don't read into it. But FHA offers are starting to get accepted at a high level right in the last quarter of 2023. This is an indicator that the frantic buyer demand is pulling back with rates and as rents come down a bit. Okay, I beat the Goldman analysis and just about everyone else out there at 7 right and 2 completely wrong and 2 that were a push. So I'll take that. Sort of right, but you know, not all the way right. So my final score is 7 out of 11, and I'll take it given the year. My next year's prediction video is about to drop on all things finance and real estate 2024. Comment below on what you think is gonna happen, and then let's get after it in the new year, guys. Thank you again, and thanks for watching the video.